This is Jeff Cooper with the Daily Market Report coming to you right after the bell on Tuesday, January 22nd. Last summer, we showed the time and price harmonics resonating with the fall of 1929, 1987, and 2018. This led us to forecast a red October. The historic declines in 1929 and 1987 laid the track for what history indicates is most likely the first leg down in a bear market that started in October. By virtue of the degree and speed with which we declined 20% in 3 months, the odds are the leg down was not a correction in a bull market. Why? Firstly, in the last 140 years, only 5 declines of 20% or greater have been bull market corrections versus first legs down in bear markets. It is rare for a correction to be that deep on a percentage basis. Additionally, another indication that what we saw was the first leg down in a bear market is the percentage retracement of the preceding leg up. In other words, we retrace significantly beneath the preceding corrective low from February 9th in 2018. This is not typical of bull market corrections as well. In other words, while everybody has been looking at the retracement of the bear market leg, quote unquote bear market leg, from September to late December, which was about 2644. And by the way, we Pinocchioed that on Friday, and this is the reaction today, down almost 50 points in a day, or down over 50 points in a day. It is just as important, if not more so, of the relationship of this decline, how much it retraces of the prior leg down from late January to early February last year. So the bottom line is there's a very strong likelihood that what we saw in the fourth quarter was more characteristic of an impulse down in a bear rather than a correction in a bull. Although let me say at the outset that there are historic outliers. There have been bullish corrections that have run more than 20%, and there have been bullish corrections that have retraced beneath preceding corrective lows. There are instances when we have had bullish corrections that have been this severe, but the point is they are rare. So this decline, the decline from the last quarter, I should say, has all the earmarks of a first leg down in a bear market until proven otherwise. Once the first leg down in a bear market is complete, there is a bear market rally. In fact, as W.D. Gans said, the lowest risk place to enter short positions is after a secondary rally. This is because you have the evidence that the market has broken the bullish pattern, and then the market experiences a short covering rally, further weakening the market when it rolls over, as the short covering buying fuel has already been spent. The median bear market rally following a first leg down typically runs 50 to 66%. Now, my initial thinking is that this secondary rally would take the shape of an ABC or a two-step rally. In that case, a B-wave pullback would play out before another C-wave push-up completes this secondary rally. However, because the the popular indices, for example, the S&P, retraced so much in such a short amount of time, this is not indicative of a rally that might have more to stretch. It is possible we get up here to 2700, 2704, but the nature of this next pullback is going to be important. Why? Because we fell out of bed from a rising wedge. The question is whether this is a first leg down, the whole thing is a first leg down in sync with the patterns from 1929 or 1987, or whether this was a first leg down, we had a rally up, and this is a plunge that equates not in amplitude, but equates fractally to the final plunges in 29 and 87. Bottom line is you have what may be a first leg down in a bear market, and this secondary rally up to resistance. Note that we Pinocchioed this neckline. I'm calling this a left shoulder ahead and a droop right shoulder. We Pinocchioed this neckline, and we Pinocchioed the 50-day moving average. I'm sorry, we did not. Let me just double check that. I'm not sure this chart is showing it correctly, but the 50-day moving average, yes, it was Pinocchio. That was around 26.30 on Friday, and we did Pinocchio that moving average. This is a weekly chart. That's why I'm here. You can see this blue line, and we did Pinocchio the 50-day MA on Friday's action. The important thing to notice in the weekly charts, go back to the weeklies for just a second, is that the S&P snapped a second rising wedge. That's not the weekly. Is that the S&P snapped a second rising wedge in October. Here you see a rising wedge that was snapped and created a plunge in February. And here you've got another rising wedge that was snapped. This time, however, there was a change in complexion following this initial secondary rally. A successful test of the October 29th low right here did not play out. Instead, another strong leg down ensued. A secondary rally back here saw a successful test of the February 9th low, and that double bottom, that successful test, perpetuated a run up to a Pinocchio of this primary high here of this late January 2018 top. Here, though, you have a different complexion. Instead of a successful test of the October 29th low that would perpetuate a rally, instead you had a failure and another leg down. So the question is whether the leg down in December was the second leg down in 1929, the crash leg, or that is yet to come. Clearly the duration of what was only a 5 to 6 day rebound following the initial first leg down in 1929 is dwarfed by the current 4-week rebound. However, what is interesting is that the first leg down in 1987 was 4 weeks, and that would equate to this 4-week leg here, and then we had a 4-week rebound prior to the crash in 1987. Here, this is a 4-week rebound. Be that as it may, the initial crash leg in 1929 was 17%. The initial crash leg in 1987 was 10%. The drop-off from October 2018 was larger at 20%. The retrace in 1929, that 5 to 6 day retrace, was 60%. A 60% retrace currently lies at 2704. So if we get a higher low here, if we survive this pullback here, and I'll show you what to look for to see if we can turn up, we may yet hit 2700, 2704. However, remember that the typical retrace for a secondary rally is 50 to 66%. The S&P satisfied a more than 50% retrace at 26.44 last week when the index struck 26.76 on Friday. As occurred last February, if another graceful exit to new highs is on the table, which played out here, then the odds are it will not play out until and unless a test of the December lows occurs. In other words, mirroring this pattern with a successful test after this plunge. And that would come in at this magenta line, the 200-week moving average. Throughout January, I have stated in the daily market report that there is potential to a new high, to as high as 3,000 plus. That is part of a bear market process. But again, I do not think this is likely at this stage, at least until a successful test of the December low is installed. Moreover, looking for two miracles, two graceful exits, in other words, here was a graceful exit number one, and two double bottoms. You had a double bottom here. Will we get another successful double bottom here? Following the break of two rising wedges, this rising wedge here and this rising wedge here, seems a bit too much to ask for. On this weekly S&P, note the convergence of trend lines, which should act as resistance. We showed this chart in our morning report, which goes out before the open every morning. And you can see that you have this trend line here. Right here, which actually you can see that this takes in this consolidation here and the lows before the January 2018 blowout, and catches the April low here, just shy of the April low here, and the October low, and that came in right about here, ties to this declining trend line with the October top and this early December top, and also you have a trend line right here that catches the February and early April low, and the congestion of these trend lines is in this region. So theoretically, the December 2018 plunge satisfied the cascades in 1929 and 87 as to pattern, but not as to amplitude. Still, at the outset, I mentioned the DNA of the 1987 and 29 patterns and 2018, and why the probability was we had experienced the first leg of a bear market, not a bullish correction. Now we are in the wheelhouse of what is a typical retracement in a secondary rally. If, and this is a big if, a crash is going to occur, the potential is that it is going to do so in the next few weeks after this secondary rally. The problem is a violent break could occur like a bat out of hell without giving much warning, such as today. This is, of course, the DNA of a crash. It occurs out of the blue. The tracks have been laid for a waterfall event if such event is on the table, but it's always important to remember that crashes are rare birds and few and far between. So my recommendation from this morning was to play things very close to the vest and to sidestep what may be, what may look like long side opportunities here in what will be a treacherous tape. At the very least, I would not be aggressive on the long side and would make sure that you adhere to any stops when carrying long positions home in this time window over the next 2 weeks. In the crash of 1987, from the 70% retracement, it took just 12 trading days for the deluge to complete. In the crash of 1929, following a 60% retracement, it took 13 trading days for the deluge to complete. If the market should top, as it looks like it may have on Friday, then 13 trading days ties to the 1 year cycle from February 6th to 9th. And it's important to remember that we have satisfied the minimum requirements for a secondary rally in rallying 55%, and rallying not 55%, but in adhering to a 55% retrace of the leg down. So how are we going to know what to look for? Let's go to an hourly chart. This is exactly what we showed on our morning report. And you can see that this is a trend line off the December 24th, 26 lows, connects the early January low, the January 3rd low, and that was broken today. And lo and behold, this is also a rising wedge on the hourly, is a fractal of the rising wedges we showed on the weeklies. So this is one of the most bearish patterns, and when you fall out of bed from rising wedge, you can often see a violent move to the downside. Today we hit 2620-ish, and the 50 period, the 50-hour moving average. Interestingly, 2623 was a level that we forecast on our private Twitter feed, that once we started down and saw an opening range break, that we would satisfy a minimum of 2623. If we break with authority below 2623 tomorrow, I think we can get down towards this 2560 level pretty quickly. And this is going to be another important level here, 2590, which ties to this consolidation level here. Let's take a look at the dailies. So you can see that even on the dailies, there is a rising wedge pattern, which we fell out of today. Be that as it may, let's spread this out here, pull it back to drill down. You can see that since the December lows, there has never been more than 2 consecutive pullbacks on the dailies. This is 2 consecutive lower daily lows right here into January 3rd, and that satisfied my +1, -2 buy position. Why? The 3-day chart is pointing up. That occurs when you get 3 consecutive daily higher highs, and it was followed by 2 consecutive lower daily lows. So +1 for the 3-day chart pointing up, and the -2 for 2 consecutive lower daily lows. That defined a low, and you exploded on January 4th. Friday we hit this trend line connecting the tops. Today we broke it, and you can see that since this +1 -2 buy setup, the S&P has only traded below a prior day's low 2 times, here and here. We did it again today and closed at near session lows, unlike these 2 instances, and the implication is that we will probably trade below today's low at some point during tomorrow's trade, and that will set up another +1 -2 buy setup at near an undercut or test of the blue line, the 50-day moving average. So that is a good buy setup, and if the market doesn't respond to it, doesn't react to it, it'll be talking. The bottom line is the China news last week moved the S&P above our initial target zone. The fact that Kudlow said the progress is being made, but it's going to take a long time, indicates to me that Friday's option expiration was probably a driving force for the move versus China news. A break below 25.90 that would have triggered a triangle pendulum sell setup on the hourlies last week as we expected never played out. That was needed to confirm a turn to the downside. Once again, though, that 25.90, let's go back and you'll see it on the hourlies, that 25.90 level right here is going to be important. You can see that it ties to these prior tops, this consolidation. So prior resistance should prove to be new support. But if it isn't, again, the market will be talking. My thinking has been that the S&P would rally, the S&P rally would either be shy of the idealized 2620 resistance, which was prior support on the way down, and the idealized 50% retrace resistance of the leg down at 2644 that everyone seems to be pointing to. Or we would exceed that region, squeezing scale up shorts, and that played out last week. Interesting that on news of a China deal being imminent and a Pinocchio of the 50 day moving average and a Pinocchio of a 50% retrace of the entire bear market leg played out into options expiration, and immediately the hangover was the biggest day down this year so far. Too many folks were looking at 2620 and 2630 for Mr. Market to accommodate, I guess. What everyone knows on Wall Street is seldom worth knowing, at least at the moment. So the bear did a good job of convincing many that the worst was behind and that the coast was clear. History suggests that conclusion is premature. Regardless of whether a new leg down plays out from current levels or not, conviction is going to kill you in 2019 because cycles imply the intense swings will continue throughout the year. History says the roller coaster ride just got started. Red October and the December massacre and the January jump was just an appetizer. The market may have more in it over the first half, up and down, as part of a large topping process, sucking the last money out of folks before the worst of the bear market actually grips the tape. But the bottom line is we've had what looks like, according to history, a primary bear leg down, the initial bear leg down, and a secondary rally. If that's true, and the DNA from 1987 and 29 is still in the wheelhouse, then heads up on this first leg down, this secondary leg down, because it may play out like a bat out of hell. With that, I'll let you go. Appreciate your time. Thanks for listening.